Welcome to Investing Lighthouse, where we explore the world of investing in the stock market. Today, we'll be navigating the turbulent waters of profiting from market crashes. We'll be learning about short selling and looking at legendary investors who've netted fortunes from market downturns. Plus, we'll discover how the Oracle of Omaha, Warren Buffett, steers through these stormy seas. So buckle up and let's set sail. Let's kick this off with short selling. It's an investment strategy where you profit from a stock's decline in value. The process involves borrowing shares, selling them at the current price, and then buying them back later at a lower price to return to the lender. Your profit comes from the difference between the selling and repurchase prices. However, short selling can be a high-risk game with the potential for unlimited losses if the stock price rises. It's not for the faint-hearted, but for those with unshakable convictions and nerves of steel, it can be a profitable strategy. Now, let's look at some legendary investors who rode the big wave and scored massive profits from market crashes. First in our Hall of Fame is Dr. Michael Burry. You may know Burry from the movie The Big Short, but there's so much more to this remarkable investor. With a background in medicine, Burry is known for his analytical approach to investing, diving deep into financial statements and economic data to uncover investment opportunities that others often overlook. Burry rose to fame during the subprime mortgage crisis of 2008. He predicted the housing market collapse and used short selling to profit massively from the downturn. His hedge fund, Cyan Capital, shorted mortgage-backed securities, earning Burry and his investors over $700 million. But that's not the only successful short position Burry has taken. In the early 2000s, Burry profited by shorting overvalued internet stocks during the dot-com bubble. More recently, in 2020, he made headlines for his bet against Tesla, predicting that the electric car company's share price was vastly inflated. Next up, we have George Soros, who famously broke the Bank of England in 1992. Soros took a colossal short position against the British pound, believing it was overvalued. When the UK government withdrew the pound from the European exchange rate mechanism, Soros made a staggering $1 billion in profit. This iconic transaction catapulted Soros into the limelight, cementing his status as one of the globe's most exceptional investors. Then there's Andy Krieger, a currency trader who shorted the New Zealand dollar in 1987. Krieger believed that the currency was overvalued and placed a massive bet against it. His trade was so large that it exceeded New Zealand's entire money supply. In the end, Krieger's short position netted him a cool $300 million. Sometimes, stocks soar to all-time highs, fueled by hype, only to come crashing down. Investors who shorted these stocks made vast profits. Take Enron, for example, once a darling of Wall Street. The energy giant's stock price soared to over $90 a share in 2000. But when its massive accounting fraud was exposed, the company went bankrupt, and its stock became virtually worthless. Those who shorted Enron reaped huge rewards. Jim Chanos, a renowned short seller, was one of the first to question Enron's accounting practices and profit from its downfall. Another case in point is Blockbuster, the movie rental giant that failed to adapt to the digital age. As streaming services like Netflix surged in popularity, Blockbuster's stock price plummeted from around $30 in 2002 to less than $1 in 2010. Short sellers who saw the writing on the wall profited handsomely. More recently, we've seen the electric car company, Nikola, rise and fall dramatically, In 2020, Nikola's stock price soared to over $90 a share, driven by excitement about its hydrogen fuel cell technology. However, when allegations of fraud and deception came to light, the stock price tanked, and short sellers who had wagered against the company earned substantial profits. Now, let's pivot to a different strategy. Warren Buffett, the Oracle of Omaha, takes an alternative approach to capitalizing from market crashes. Rather than short selling, Buffett invests in undervalued stocks when others are fearful, holding onto them, and letting compounding interest work its magic. As the economy recovered from the 2008 financial crisis, Buffett strategically invested in several opportunities. One of these was a $5 billion investment in Goldman Sachs, a move that eventually netted Berkshire Hathaway billions in profit. Buffett also injected $3 billion into General Electric during the crisis, providing much-needed capital and later earning a substantial return. Buffett's long-term, value-oriented approach allows him to ride out market turbulence and emerge even stronger. But it's not just during crises that Buffett finds opportunities. He also takes advantage of temporary market downturns and dips in individual stock prices to buy quality companies at a discount. For example, during the dot-com bubble, when investors were going gaga over tech stocks, Buffett stayed away from the overvalued sector, instead purchasing shares in established companies like Coca-Cola and American Express. His focus on the fundamentals paid off when the bubble burst, and many tech stocks went belly up. While short selling and value investing can be profitable strategies during market crashes, it's crucial to understand the risks involved and diversify your approach. You could consider adding safe haven assets like gold or bonds to your portfolio, or using options to hedge against market declines. Remember, the key to success in investing is staying informed, doing your research, and maintaining a long-term perspective. Market crashes can be nerve-wracking, but they also offer golden opportunities for savvy investors who know how to navigate the storm. And there you have it, folks. Profiting from market crashes may seem like a tall order, but armed with knowledge and the right mindset, you too can ride the big wave and come out on top. Always remember, investing carries risks, so be sure to do your homework and never invest more than you can afford to lose. We're eager to hear your thoughts and feedback, so please feel free to leave your comments in the section below. If you found this video informative and useful, please show us some love by smashing that thumbs up button and subscribing to our channel. Thanks again for watching, and we look forward to seeing you in the next video.